Hello friends, how are you? I hope all of you are doing really good. So welcome to the Economics of Finance Excellency batch. If you are new to the channel, please do not forget to subscribe to the channel and press the like button and share with all your friends. Okay, so what we have been doing is we have started with chapter number 8, that is on money supply. So in the last lecture, we discussed about, sir, what is money supply? What are the various sources of money supply? We discussed about the significance of the money supply, that why it is important to measure the money supply. Now, while discussing the sources, we discussed that there are two major sources. One is the central bank of the country and another one is the commercial banks. And the central bank is printing the currency. That is why that is the primary source of money supply. And how the commercial banks help in the money supply, that is through credit creation. They take the money in the form of borrowings from the public, and they give loans and credits to the person who need that loan, right? So this is how the money supply is being created by the commercial banks, right? Now in the last lecture, we said one thing here. What, sir? That this quantity of money at any point of time. So what we are saying is that this quantity of money, sir, this quantity of money at any point of time is a measurable concept, right? The point here is, if it is measurable, then how it is measured, right? So there are certain rules, there are certain, the criteria that is given by the central bank, that how we can measure the money. That is where we come this topic, that is the measurement of money supply, right, with the help of monetary aggregates, right? So what was it here? Now we need to understand that what are these various monetary aggregates. So when we are talking about the measurement of money supply, when we are talking about measurement of money supply, you need to have an idea. Measurement of money supply. Now I say the measurement of the money supply is dependent upon the monetary aggregates, right? So there were three categories. There are basically three categories, that this was divided into three categories. One is known as monetary aggregates, right? Monetary aggregates. The second is known as new monetary aggregates. The second is known as new monetary aggregates. And the third one is known as liquidity aggregates. Liquidity aggregates. Right? Now, what are the monetary aggregates? See, initially, what the central bank did was, the central bank has given four criteria for monetary aggregates. Aggregate means the criterias, right? So there were four criterias which were given. What were those criterias? Those were M1, M2, M3 and M4. 1, 2, 3 and 4. Right? Now, what was the basis of this? The basis of this was liquidity. That based on how liquid this criteria is. Liquid means how quickly that criteria is being converted into cash, or it is a cash, right? The liquid money which can be used, right, or which can be easily converted into cash so that it can be used. So it was based on the liquidity. Clear? But later on, in what was the year, in 1998, this new monetary aggregates came into place in 1998 on the recommendation of the working group of money, right? So this came into place on the recommendation of working group of money, right? So now there were new monetary aggregates. These were named as NM1, right? The second was named as NM2 and the third one was NM3, right? Again, these are based on liquidity only, sir. Again, these are ranked on liquidity only, but there were three different ways in which the new monetary aggregates were presented. Initially, there were four monetary aggregates, M1, M2, M3 and M4. after the recommendation of the working group in 1998, there were new monetary aggregates which consisted of NM1, NM2 and NM3, right? And after that came the liquidity aggregates. Now these liquidity aggregates were a part of this new monetary aggregates only, right? On the recommendation of this working committee only, the liquidity aggregates were also defined. Now what are the liquidity aggregates? These liquidity aggregates were L1, L2 and L3. L1, L2 and L3. Now what are these liquidity aggregates? Sir, these are those instruments, right, which are near to money in nature, That means these are those financial instruments, which are quite close to the nature of money, what the money can do, that financial instruments can also do. These are issued by non-banking financial institutions. Non-banking financial institutions, right? So these are the liquidity aggregates. These were added in 1998 only along with the new monetary aggregates, right? So these were the instruments which are very near to the money in terms of nature and which are issued by the non-banking financial institutions. That means all those institutions which are not into the core banking thing, right? So if any monetary supply is by those institutions, that came under the liquidity aggregates of money supply. He says that is a money supply, that is a money being supplied, right? It is being supplied by another person or another institution which is beyond the core banking institution. Clear? So this was given there. So these are this is how we measure the money supply. Now we need to see what all is included in these aggregates. What is included in M1, M2, M3, M4, and what is there in NM1, NM2, NM3, what is there in liquidity aggregates. See all these things. For this particular topic, I will say you will have to remember the few things, right? You will have to remember a few things. You will have to go through multiple times and you will have to remember a few things, right? Okay. So the first set is the measurement of money supply. In that, the first set is monetary aggregates. That was the initial set, that initial criteria how to identify the supply of money in an economy. So this was divided into four parts: M1, M2, M3 and M4. What was included in the M1? The M1 included the currency held by public, that whatever the currency is with the public. And what is the definition of public? We discussed it in the last lecture, right? This definition of public, the public means all the economic units except the producers of money, right? So he says whatever the currency is, currency in the form of notes, in the form of coins, whatever is the currency that is held by the public, that will be included in the money supply. Plus the net demand deposits of the banks, CASA accounts, CASA deposit. What is CASA deposit, sir? CA stands for current account and the SA stands for savings account. And these are what? These are the demand deposits. Demand deposits means anytime you can go to the bank, present the check and you can get the cash out of that account, right? On demand, you can withdraw your money. On demand, you can deposit your money anytime as per your requirement, as per your wish. That is why these are known as demand deposits. Now, one thing important here, sir, why this word net has been used here? Demand deposits, we understand that if I have an account in the bank, I have a savings account, I have a current account, whatever the money is lying there, that is a part of money supply. That is absolutely fine. But he is using the word net here, net demand deposit. What is the purpose of using the word net here? He says the net demand deposits is equal to total demand deposits minus the interbank deposits. That means if the SBI is having a saving account with PNB, let's say, right, they have opened an account with the PNB, kept some money with the PNB. That is what these are known as interbank deposits. And this is not included in the supply of money, right? The money is lying in one bank or the another bank, hardly matters, right? So if I have deposited money in the SBI, that is included. But if SBI takes that money out and deposit it in the PNB, right? So that is not included. Otherwise, it will lead to double inclusion. So the interbank deposits are not included in the definition of M1. That means if it is not included in the definition of M1, it means it is not a part of money supply. Clear? Plus the other deposits of the RBI, if there are any other deposits with the RBI, those are to be included in the M1. Now here the note is given. He says, what is currency? When the word currency is being used, he says the paper currency plus the coins with the public, right? Then this is regarding the first point only. Then he says the demand deposit of the bank's current account and the demand deposit portion of the savings deposit, all held by the public. Public here means it can be household, it can be firms, it can be quasi-government institutions. So all those who are included in the definition of public. So any current account or the savings account of that public, right? He says these are also called the CASA deposits, and these are the cheapest source of finance for a commercial bank. Obviously, sir, we just studied that commercial banks, how do they create the supply of money? Through creating the credit. Now, let's say I have deposited 10,000 rupees. Why it is called the cheapest source? Let's say there is Mr. A, right? He is having a savings account. He is having a savings account with SBI. Right? Now he has deposited 1 lakh rupees. Now what will SBI do? SBI is paying interest on savings account at the rate of 3% only. 3%, 4%, whatever. Now, what will SBI do with this money for creating the money supply? Now, SBI will lend 1 lakh. Lend 1 lakh to Mr. Y. Right? So this money has been lended to Mr. Y at the rate of 10% per annum. So deposits are at the rate of 3%, whereas the lending is at the rate of 10%. That is why. And in case Mr. A is having instead of saving account, Mr. A is having a current account, then what will happen, sir? This interest rate is 0. On current account, you don't get any rate of interest, right? And the same money they are going to lend to another person at 10%, 12%, 15%, whatever the rate of interest related to that particular loan is, right? So that is why these known as these CASA accounts are the cheapest source of finance for a commercial bank due to nil interest on the current accounts and the low rate of interest on the savings account, right? And the interbank deposits are to be excluded, right? These are the exclusions which are given to you. As these are not held by the public, these are held by the banks itself, right? Then he says other deposits of the RBI. What are the other deposits of the RBI? So demand deposits of the quasi-government institutions, other financial institutions, they have some money with the RBI, right? Balances in the accounts of the foreign central banks and the governments. If the foreign banks or the foreign governments are having the accounts with the RBI, the money is kept in that, right? That is a part of money supply. And the balances in the accounts of international organizations or the agencies like the IMF, World Bank, if there is any balance with that, with the RBI, right? So that is included in the definition of M1. Now, what is to be excluded? He says the RBI's deposits held by the government, the central and the state government, if any deposits are with the government. Now, just remember one thing, why it is being excluded? Sir, this is excluded from the definition of public also. It is excluded from the definition of public also. So the government, any money which is being held by the government or the interbanks, that is to be excluded, right? So this is the M1. Clear? Now he says, let's broaden little bit, right? He says, what is M2? M2 says all the items of the M1 plus the saving deposits with the post office savings bank. If you open an account instead of the bank, if you are opening an account with the post office, right? So whatever the savings account is with the post office, that is also to be included in case of M2, right? So the scope has increased in the M2, right, sir? Now, in case of M3, what is M3? M3 says whatever is included in the M1 plus the net time deposits with the banking system. Sir, what is time deposit? The deposit which is there for a fixed tenure, for example, the fixed deposit. So you need to be very clear, clear with the demand deposits and the time deposits, right? Okay, so when we are talking about the deposits, you need to be clear with this thing that what are the deposits? Two type of deposits are there. One is demand deposit, right? And another one is time deposit, right? So what is there, sir? In case of demand deposit, you can demand money anytime. You can demand money anytime, right? So here we say when it is a time deposit, the money is held in the system. Money is held in the system. In the system means in the banking system for a particular time period. For a particular time period. That means it is not possible to withdraw the money anytime, anywhere. Here you can go and withdraw the money from the ATM, from bank, right? So these are demand deposits. That is why the CASA accounts, that is current and savings account, is an example of demand deposit. And if you talk about the time deposit, the fixed deposit, the FDs, right? The FDs that you do with the banks, that is for a particular period of time only. Then you will get the rate of interest. And if you try to break it before the stipulated time, you will have to pay the penalty for that, right? So CASA accounts is your demand deposits and the fixed deposits are your time deposits. Clear? Okay, so this was the M3. Now in the M3 it says let's take the time deposits, and in the M4 it is M3 plus M3, right, plus the total deposits with the PO savings bank. So M3, in case of M3, if you look at it, the M3 excluded any accounts with the this post office savings, right? M3 excluded any accounts with the post office. The M4 included that. Now in the M4 it says M3. M3 is M1 plus the time deposits with the banking system. M4 says M3 plus the total deposits. Total deposit means whether it is a demand deposit, whether it is a time deposit with the PO savings bank, excluding the NSC, that is the National Savings Certificate, excluding that. If there is any kind of deposit, whether it is a demand deposit or whether it is a time deposit, it will be included, right? So M1, M2, M3 and M4. So M1 is known as narrow money and M4 is known as the broad money, because the M1 covers covers less of things and the M4 is a broader aspect. The broader things are covered in the M4. Clear? So these were the initial monetary aggregates which were given by the Central Bank of India. Clear? Now, after this, after the monetary aggregates, let's come to the new monetary aggregates, right? This reserve money we will come later on onto this after the new monetary aggregates and the liquidity aggregates, right? So what were the changes which were done in the new monetary aggregates and the liquidity aggregates, sir? Let's try to understand. Let's start with NM1. He says currency with the public plus the demand deposits with the banking system plus the other deposits with the RBI. So it was the same as with the M1. The NM1 was same. Any changes? No, sir. After that, he said add the short term. What is the word he's using? He says the short term time deposits of the residents, that is including and up to the contractual maturity of 1 year, that becomes the NM2. He says the time deposits, but these are short term up to a period of 1 year. You cannot withdraw for whatever the maturity is, right? If it is 9 months, you cannot withdraw it before 9 months, but the tenure is less than 1 year. It is a time deposit. That means you cannot go to the bank anytime and withdraw it from the ATM or from the banking system. It will be there for a particular time, but that time will be less than 1 year, right? So that is included in the NM2. After that, that is why it says it is based on the liquidity. It keeps on expanding the criteria. It keeps on expanding, the items being included in the various aggregates. Then comes the long term. After the short term has been included, comes the long term time deposits of the residents, right? Which is for a period of more than 1 year. Plus the call and term funding from the financial institutions. If there is any funding, on call or term funding from the financial institutions, that is also included. Funding means the borrowing, right? If there is any borrowing for a particular period of time, for a particular term is there, or for the call and term means for a particular period of time, if there is any borrowing from the financial institutions, that is the banking institutions, right? That is included in the NM3. So here we come with NM1, NM2 and NM3. NM1 is same as M1, right? After that, in the calculation of NM2, we have added the short term deposits, right, up to 1 year. Then in NM3, we have included the long term deposits plus the call or term funding from the financial institutions, that is NM3. Now, if you look at these three variables now, right, what was this? I'll go to the monetary aggregates. In the M2 itself, we say post office savings bank, right? Now this is not a core, this doesn't is not covered under the core banking system, right? This is not covered under the core banking system, right? So when the new monetary aggregates were introduced, right, the first three aggregates, all these things are related to the core banking, right? After that, the liquidity aggregates came into the play. The liquidity aggregates were any instruments which are money or near to money, but which are issued by institutions other than the core banking institutions. That is what I told you here, that instruments which are money or near to money issued by the non-banking but financial institutions, right? So the first three were related from exactly the banking institutions. The next three, that is L1, L2 and L3, included all those financial instruments which are issued by the non-banking financial institutions. So what was there in the L1? L1 included all the deposits from the post office savings bank excluding the NSC, right? So what was there? Earlier it was in the form of M4, right? This thing was included in the M4. Now it has been renamed that it will be included in the L1, that is the liquidity aggregate 1. After that, what is included in the L2? What is included in the L2 is L1 plus the term deposits with the term lending institutions and the refinancing institutions which are not bankings, which is not in the core banking system. Any lending institution which is outside, right, which is outside the core banking system, whose journal operations are not what? These are not the banking one, right? But they provide you with the loans, they provide you with the term deposits, or you can deposit money with them for a fixed tenure and they will be paying you interest just like the banks, but they are outside the banking system. Clear? Then is the term borrowing by the financing institutions and the certificates of the deposits issued by the financing. There is a particular financing institution. He says, give us the money and we will give you the certificate of the deposit. So it is what? You are depositing your money in the financing institution. That financing institution will use your money to lend it to some other person, just like the commercial banks, but they are not the banking system, and they will give you the certificate of the deposit, right? So that becomes L2, and L3 is what? The public deposit of the non-banking financial companies, that if there is any public deposit with the NBFCs, right, which are non-banking financial companies. Sir, what is the major difference between the banking and non-banking? The non-banking financial companies are not regulated under the RBI or under the banking rules, right? So there are separate set of rules for those particular companies, right? So this is how the new monetary and the liquidity aggregates were calculated, right? This is how the new monetary aggregates and the liquidity aggregates have been calculated. Now we have discussed you need to learn these things by heart, right? You will have to learn in the sense that if you are going through this very carefully, right, and if you just try to make some synchronizations, you will be able to remember. These are not too difficult to remember, isn't it? This is very easy to remember, sir. Now comes another topic, that is reserve money. Now what is a reserve money, sir? Reserve money is the money of the central bank. Simple. Reserve money is what? Money of central bank, or the money which is being supplied by the central bank, the money which belongs to the central bank. This is also known as what? This is also known as high powered money. This is also known as high powered money, right? So he says, how can we identify what is the money of the central bank? What is the amount of money of the central bank? Right? That means how to calculate the reserve money. He says there are two approaches to calculate the reserve money. One is the liability approach, right? That means the central bank has the liability to pay someone, and another one is the asset approach. That is, the central bank has the assets. Whatever the money is, that is the asset to a central bank. Now that means how to calculate the reserve money. It is based on the balance sheet of the bank, right? So let's first try to understand what is reserve money. Reserve money is also known as the central bank money, base money, or the high powered money, right? Reserve money plays a critical role in the determination of the total supply of money. Obviously, whatever the money is there with the central bank, right, that plays a critical role in identifying what will be the supply of money in the economy, isn't it? The management of reserve money is important to stabilize the liquidity, growth, and the price level in an economy, right? So reserve money plays a very vital role, very important role in stabilizing the liquidity, growth, and price level, because higher the reserve money, higher the money will be supplied into the economy, higher the money the people will have, they will demand more demand will lead to the higher prices, and the higher prices will lead to the inflation, right? Now, what are the two approaches? Reserve money can be calculated by the liability approach. What is included in the liability approach? He says the currency in circulation or held by the public. Now, the central bank is liable to give that money to the public, sir, right? Isn't it? Plus the bankers deposit with the RBI. Now, the RBI says to the bank that if you are getting 10,000 rupees from a person, you have to deposit 2,000 with me, and 8,000 you can use further for lending. In the same example I took in the last lecture also, I think, right? This is this example. So this 2,000 here is what? This 2,000, right, this will be deposited with the central bank. Now this is the liability of central bank, because this money belongs to commercial banks. The central bank is holding that money. So this is what? This is to be included in the liability approach. These are the commercial banks deposits with the RBI, right, for maintaining the CRR, that is the cash reserve ratio, and the working funds for clearing the adjustments, plus other deposits with the RBI. If there are any other deposits with the RBI, what are the other deposits with the RBI? These are the other deposits with the RBI. RBI is having that money, but it is a liability for the RBI, right? Because the RBI has to give that money. If it is public money, it is to be given to the public. If it is, IMF or the World Bank money, the central bank will have to give it to whenever they demand. So it is a liability. It is a money supply. RBI can use that money, but it is the liability side. Clear? Now, if we study, so this is the reserve money. Now, if we study from the asset approach, he says the net RBI credit to the government. If RBI has given a loan to the government, a credit to the government, right? So that is what? That is an asset for the RBI. RBI can recover that money. RBI credit to the commercial sector, to the business sector, right? RBI's claim on the banks. That means RBI's claim on banks means the banks have to pay something to the RBI. RBI can claim that money, right? So that is what? That is an asset. RBI's net foreign assets. If there are foreign assets which are held by the RBI, right? That is an asset, sir. RBI can sell those assets and convert it into cash, right? Into money, into liquid money. Then the government's currency liabilities to the public. Now it is again any money which is the government's currency liability that will become the asset for the RBI. That money ultimately belongs to whom? That money ultimately belongs to RBI. Less. Until here we are doing add. Now he says less if the RBI's net non-monetary liabilities, if the RBI is having any liability, non-monetary liability, that is to be subtracted to calculate what is the net money that belongs to the central bank. Clear? So this is how the reserve money is calculated using the two approaches, that is liability approach and another one is the asset approach. And significance of reserve money, this can be asked in the examination as such, right? So what is reserve money versus narrow money? Narrow money was what? Narrow money is M1 or NM1, right? So narrow money says currency held by public plus CASA deposit plus other deposits of RBI, least liquid money, and reserve money is currency held by public that matches at the banker's deposit with the RBI. This was not included in this M1. Here it was the public deposits with the bank, demand deposits with the bank. Here he says the banker's deposit with the RBI. Other deposits with the RBI are same. So this is the major difference between the narrow money, or what we call it as M1, and the reserve money. In the M1 we take the public demand deposits, that is the public deposits of the current accounts and the savings account, whereas in case of reserve money we take whatever the commercial banks are keeping the deposits with the RBI, right? So that is the major difference between reserve money and narrow money. Clear? So we have discussed about all the aggregates here. We discussed about the monetary aggregates. We discussed about the reserve money. We discussed about the new monetary aggregates. We have a few practical problems that we will discuss, but we will discuss later on. In the next lecture, we'll be discussing about the determinants of the money supply. Then we'll discuss about the concept of money multiplier. Right now, this is an important concept, money multiplier. Then the money multiplier approach to money supply. What is there? Just small topics. Credit multiplier is there. Small topics are there. We'll try to cover it up as soon as possible. I think we'll take another 2 or 3 lectures to complete this particular chapter, right? So I hope whatever we have covered so far is absolutely clear to you. If you are liking the content, please do hit the like button and share with all your friends in WhatsApp, Telegram, wherever you can. Just share it, and it will be great to the cause of this educational cause of quality education at affordable prices by the whole team of KSJ Teaching, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.